Hello and welcome to this episode of Akrinos Access. I'm Eric Matei, joined by Joe Erickson, CPA of Erickson Tax and Advisory. We're talking about the world of accounting basics in your practice. So we've got a ton of great content to jump into. But for starters, Joe, hello, welcome. Thank you so much for joining us on this episode of Access.
Yeah, thank you for having me.
So look, I know we've got some really fascinating things to jump into, so let's go ahead and jump into it. And again, for those of you joining us live, if you got any questions or comments you want to drop in real time, go ahead and drop them in the chat. We'll certainly inject them into the conversation here. So let's start with this, Joe. So you are a CPA. You work with a ton of medical professionals, optometrists, dentists, what have you. So let's start the conversation by just touching on, what is the importance of accounting basics to your practice?
So I would say for any medical professional that it is very important to have good kind of like accounting basics set up so they can make the best decisions for their business. You want to make sure that you're keeping track of everything going in and out of the business, where your money's coming in from, where your expenses are going, so you have an idea, okay, what is being spent on each item per month and per year. And then also from an accounting basis, make sure we're keeping track of like the tax ramifications and the tax effects of all of those decisions that you're making. So you can make sure you're doing everything optimally from a tax perspective, making sure that you're keeping track of everything accurately. So then a CPA or accountant can look at it and chat with you about, okay, what deductions and credits do you qualify for, and make sure that you're taking advantage of everything in the tax code. And it's mainly just something that you have to be keeping track of if you want to optimize everything in your business. Otherwise, if you're not keeping good accounting records of everything, it's really hard to make sure you're doing everything optimally, and it ends up costing you money in the long run.
Yeah. So I suppose on that note, that at the ground floor of all this is proper bookkeeping habits, right?
Correct. Yeah. There's even for small, like even if you're just doing working as like a 1099 contractor as like a freelance a couple days a week, I think that there's like some important things that you can do from like a bookkeeping perspective that isn't even always necessarily bookkeeping. If it's something that you're just working as a contractor a couple days a week where you're setting up like an LLC for yourself to do that, even something really basic like having your own business bank account and credit cards that you have all your business income run through and then have all your expenses go out of makes it so much easier from like a tracking purpose of everything. So even for like a basic 1099 contractor, doing something like having your own business bank account is something that you should be doing to just make it easier on yourself at year end.
Yeah, absolutely. And then obviously, adapting that and scaling that as to where someone is. And look, and we have many in our audience who are leaseholders, many who are employed or contract, many who are practice owners, and many who are excited to start a practice. So on that note, Joe, let's kind of explore a little bit and maybe start the conversation speaking from a tax planning standpoint, right? So for starters, why don't you just define for us, what is tax planning?
So tax planning is usually when you are kind of looking and having like evaluating kind of what your situation is throughout the year and saying like, okay, based on this like, here are things that I can be aware of that could potentially lower my taxes or be optimal for my taxes in the future, and make sure that you're evaluating where you're at in your financial picture kind of throughout the year and making sure that, okay, once I've evaluated where I'm at, what decisions can I make and how do they affect my tax situation? Because really, when you think about it, every decision that you make, even if you don't think about it, affects your tax situation somewhat. Even stuff that you don't even like really think about. Because say, for example, like a lot of times people don't think about the tax consequences if they were going to move from, let's say, let's say you're in Louisiana. If all of a sudden you move from Louisiana to California, you're in a state with a higher income tax. So there's like, you wouldn't think that there's an income tax decision to the decisions that you make, but there is when you, even something as basic as like, oh, I'm moving from this state to this state. Well, there's tax ramifications of it. So it's mostly just tax planning is just where you're at right now and what your current future plans are, and just make sure you're aware of anything that you do that has and what the tax consequences of those decisions are.
So in that regard, and I know if we go back to our one of our meetings prior to this, and I know something that we work very closely on, right, as far as working together with doctors who are cold starting practices, right? Let's now take that a little bit further. If you can comment on tax planning from the perspective of the cold start doctor versus the doctor who is in the peak of their career, and then compared to that doctor who is perhaps looking to retire and sell and move on. So let's maybe start it from the cold start perspective. What are some of these tax planning tips or need to knows for the cold start doctor?
So for cold start doctors, it really just depends. I mean, so oftentimes when you have a cold start doctor who's starting a practice, that initial year you're starting, you are pouring through a loan a lot of money into the practice. And a lot of times the tax planning on that is as there can be something where it's like, hey, as you're buying equipment, do you want to take immediate depreciation on that, or do you want to have it depreciated over a number of years? Usually for cold start practices, just because they're not making money that first year and already having quite a few expenses, you usually want to defer expenses over a period of time throughout the year. So for cold start practices, that's kind of a big one. And then kind of like, and this is kind of the case with everybody, whether you're beginning of the career, in the middle of career, or late in the career. As you have an idea of what your income is throughout the year, making sure that you're aware of what your tax liability is going to be at year end.
Oh, yes.
Nobody likes having to write checks for taxes, but it's even worse when it's a surprise writing a check for taxes. So oftentimes, like, I advise my clients to especially meet towards the end of the year when we have an idea of what your income is going to look like, so that I can kind of make an estimate at that point. Okay, come April, this is going to be your tax liability. And you might not like that you have to pay taxes, but at least you'll be aware of it 4 or 5 months in advance. And that's actually the main thing I would say for people in the middle of their career, where they're kind of have their practice and are, from a tax planning perspective, a lot of it's going to be what's your tax liability, and make sure we're like planning that out so you're aware of, based on your income, what's your tax liability is going to be like at the end of the year. Now, there can be some things that we do to lower tax liability on those, as for example, we can set up, if you have your own practice, you can set up, different 401k plans for you and your employees that will allow you to stash more money away in retirement tax deferred accounts. If you have a really high income year and you were looking at buying, equipment, we can say towards the end of the year, hey, you're in this higher tax bracket this year, you made more income than normal. If you buy this equipment, this $100,000 piece of equipment that you're planning on purchasing in the next year anyway, you'll get that immediate tax benefit at a higher tax bracket than you would if you purchase it next year. So that's kind of like a lot of the things too with tax planning, is just, making sure we're, aware of where your income's at, and then what are some of the smaller things that you can do to lower taxable income. And then actually the big one too, that there's a lot of planning as you get towards the end of your career, and a lot of practice owners are then selling their practice. A lot of times how those deals are structured can determine what their tax liability is going to be. A lot of times people get paid out and they get one large lump sum in 1 year, which is obviously great from a cash flow perspective, but it can also put you in the highest tax bracket, where you could actually be paying less in taxes if with seller-backed financing, where you're financing the new purchaser, where you might want to spread that out over a number of years. So you're not getting all this money in 1 year. You're getting it on a note with a good interest rate over a number of years. So it wouldn't be potentially a huge amount of tax savings, but if you set it up correctly, you could maybe save 5% of taxes, 5% of the total price over a number of years. So not, you you wouldn't think that's like a large amount, but maybe on like $1 million practice, it's, $50,000 that you can save in taxes over a number of years. So it's mainly just making sure you're talking with somebody who's aware of all the tax laws, so you can make sure you're planning stuff. And there isn't there's situations where it could be like, hey, is there anything I could do to save on taxes? No, there isn't. But like, you want to always just like make sure that like if there's something that you can do to lower your tax liability and you have that option, you have the ability to do that and are aware of that option.
Absolutely. And on that note, then that again points back to being contingent on the fact that the books are being properly maintained, right? That we have quality coming in, quality content coming in, such that the cash flows and hence the tax liability can be adequately projected, right? And around that, I mean, I suppose the big thing that I'm hearing here is get with a professional, get with someone that you trust to see to it that wherever you are in your career, that your accounting strategy or tax strategy is going to be in your best interest. And again, realizing that it will be different from the cold start to the peak of career to, mature career and what that might look like.
Yeah, that's correct. And it's also too, like, I think it's somewhat important too, is as you're like talking with, your trusted professionals, a lot of times too, you're going to ask questions about kind of like future plans as well. Because then if your professionals know what your future plans are, then it makes it easier to start planning for the future. We have a little bit of like runway so that you don't find something out where they're, oh, I'm planning on this and I want to do it in 2 months. Well, then there's not as much runway for planning. And if there is potentially something that you could be optimal from a tax side of things, it might be possible in like a 2-month period. No, but if you know that like, hey, I want to do this in like a 4 or 5 year period, they can maybe start planning to get everything done in like a more optimal way where you're not having to, if it's something in 2 months, it could just be, oh, well, you have to do this now and then suffer all the tax consequences. Where if it's a longer period of time, they can maybe plan something out over a number of years that would be more optimal from a tax perspective.
Yeah. Yeah. And so, I suppose I'm really glad you bring that up. Again, it's all about awareness, understanding, and planning is really what a lot of this is about, right? Before we leave this topic, though, I know to go back to something that you and I were talking about before we went live this evening, and that was how tax strategy, we'll say, can impact the value of the practice, can impact the value of a business. Why don't you speak to that a little bit? I know I shared with you a couple of cases that we came in contact with just very recently with doctors that we're helping purchase practices. And when you dig into the financials of that business, depending on how they were managing their financials, can get some starkly different outcomes. So why don't you speak to that, Joe?
Yeah, so I think like I think the important thing with taxes is you're allowed to take the deductions that are legally allowed, and there's like certain lines that you don't really want to step over. Sometimes you see people that are deducting stuff that's probably a little bit like on the dicey side of things, and it ends up from a tax perspective lowers their taxable income so where they're not paying taxes. And because I always say is that like you want to be aggressive, but there's clear lines you don't want to step over. But the issue is sometimes then when people that are kind of doing that get their practice evaluated, well, then there's less net income there where the practice isn't as attractive to a buyer, and you'd have a lower valuation than if you were taking, look, you want to take every deduction that's legally allowed, but you don't want to step over any lines. And if you are, then it could show you'll have a lower income, but then you'd have a lower valuation on your practice when that happened, or when you got to the point where you're trying to sell.
Yeah. And thank you again. This is something that we've come across this. Unfortunately, it's kind of frequently, but I think the takeaway here with everything is tax planning is all about understanding first and foremost where you are in your career, right? Because realizing there may be different things available to you or different best paths forward depending on where you are and what those objectives are. And then to get with a professional and plan for it. Take the time to plan, right? It's far better to pay accurate quarterlies than to under project yourself thinking that you want to hold on to your money and then being popped with a huge tax bill at the end of the year.
Yeah.
I mean,
that's the main thing. And it's like, even if people underpay their quarterlies, because like you run into some people who just don't want to pay quarterly and just want to pay one big bill at the end. The main thing is just being aware of what that bill is going to be.
Sure. Yes, absolutely.
So you don't think like, you just don't want to be a situation where you think you're going to owe $50,000 and then it's $100,000 that you have to then write a check for.
Yes.
And you find out a couple days before it's due.
Yes. Although I would say pay your quarterlies in the same exact way that you dollar cost average into your long-term investments, right? Mm-hmm. I mean, it's the same thing. Like, do it with consistency. Anyhow, okay, moving along. So tax planning, Joe, thank you so much. Great insights there on the tax planning front. So now let's jump into, I suppose, what is kind of the driver of the taxes. And I know in our experience seems to be one of the top considerations for doctors, especially those looking to get into private practice. But no matter what their setup is, incorporation. So why don't you give us the lowdown on S Corp, C Corp, PLLCs, and by the way, also I suppose here we should preface it with saying, Joe, you're not giving tax advice right now, right? Like, you're not giving legal advice. You're not giving any sort of advice. You're speaking in generalities. Yeah.
So speaking in like generalities, because like I think with all of this stuff, you need to talk to somebody who specifically knows your situation. With a lot of I think like what happens a lot of time is people hear tax advice on the internet where it really only applies to this very specific situation.
Exactly.
And they'll try to apply it to their situation. It doesn't always work.
Oh my gosh. Is that where the SMH, the smack my head emoji, comes from? Like, oh, I shouldn't have assumed what was in someone else's best interest was in my best interest.
Yeah, because a lot of times, like, a lot of like advice on this is going to be dependent on so many different factors.
Sure.
It's going to be based on like the income level, the state. Yeah. It's going to be your situation too. So I think like the main thing to look about this though is especially for doctors that are looking to incorporate. So the main things I guess I would say is there's two things. So there's like a lot of times like the first initial one is kind of like the sole prop versus the PLLC. And so there are some businesses where it isn't necessarily like important to if you're a sole prop versus a PLLC. And just for doctors who are doing any type of practice on their own, it is very important to become an LLC or PLLC, depending on the state, just because in any type of medical field, there is a high likelihood where at some point in your career, you are probably going to get sued by somebody. And just because of that, you need to have that extra layer of protection of an LLC, PLLC, where if for some reason you are sued, the only thing that would then be liable is the assets of the corporation, not your personal assets. There isn't too much like tax benefits of being an LLC or PLLC versus a sole prop, but the differences between like an LLC and PLLC versus a sole prop is more from a legal perspective. You want to do that to protect yourself legally, not necessarily for like tax reasons.
Sure. Mm-hmm. Okay. So now let's then get into S Corp, C Corp, and again, for viewers out there, connect with a professional that knows your state, right? Because that's another thing as well. Like, how can an optometry practice be owned? How must it be incorporated? But why don't you give us the lowdown on differences between S Corp and C Corp?
Okay, so yeah, S Corps and C Corp. So those are both tax elections. C Corps for optometrists, you rarely ever see anymore. I would almost never recommend that. Usually with C Corps now, what those are, they're usually the C Corps that I see or hear people talk about, usually tech companies that are attempting to get public funding at some point.
Sure.
most individuals who are owning an optometry practice, you are not even going to really evaluate a C Corp at all. It's not going to be something that you ever do. Um, However, the S Corps are something that a lot of people do. So an S Corp is, and it's really not like a different type of corporation. You're still an LLC or PLLC. Electing to become an S Corp is just a tax election. So you're electing how you are taxed. So how an S Corp election works is if you are becoming an S Corp, how that will work is that you then, instead of usually for, if you're just a regular PLLC or LLC, oftentimes what happens is that you have a Schedule C on your tax return where you report all your business income and expenses, and you're just filing one tax return. The PLLC or LLC is just a schedule on your tax return. If you're an S Corp, what's happening is that you're doing a separate tax return for the S Corp, which then flows through to your personal return. So the federal income tax is federal on the federal level. You are having then the income from your S Corp, where it's like a separate tax return, then flows through to your personal return. Depending on so you're not paying any federal income tax at the corporate level. You're still paying it all at the individual level. The corporate tax return on the corporate level by state, some states are going to charge like an additional franchise tax or revenue tax based on the number if you're an S Corp. But that's just going to depend state by state. The main benefit of the S Corp versus the PLLC or LLC, though, is you're potentially paying less in self-employment taxes, which is the Social Security and Medicare taxes. So for most people if you're working a job for an employer, you kind of notice that on your W-2, you have Medicare and Social Security taxes that are taken out every paycheck. Now, that's your portion of it, but then your employer is also paying the exact same portion on that. So that usually ends up being it's 15.3% of the first. Cannot remember the Social Security wage base off the top of my head. I want to say it's 150,000 roughly right now.
We can Google it. I'm sure we could Google it. We can Alexa. I don't have Alexa but here.
Then it's 2.9% of Medicare wages. So that's the amount that's taxed. Now, if you're an S Corp, how that works is that instead of paying it on everything, you're just paying it on the wages that you pay yourself. Now, you're required to pay yourself a reasonable wage, but then you're only paying the Social Security and Medicare on the amount you're paying that as a wage. So if you have excess amounts after that, you are not paying the Social Security and Medicare tax on that. So depending how much money and income you're generating in your S Corp, you can be saving a decent amount in taxes on Social Security and Medicare wages.
Fantastic. That is really, really good to know. Okay, so now let's push the conversation a little bit further, and let's maybe shift gears into the world of how do you pay yourself?
Mm-hmm. So it's going to depend on how you're set up. So I guess we'll kind of talk about like both main structures where you're just like the regular LLC, PLLC, and then if you have an S Corp election too. So
sure.
if you're a regular just LLC, PLLC, where you're not making the S Corp election, you would honestly just take everything as draws from the business. All of the income that's in the business, whether you draw it or not, it's taxed at the end of the year. So you're paying taxes on it whether or not you leave it in the business as just cash or you withdraw it to for personal use. So all of the money that's in the business is going to be taxed at the year that it's earned. So if it's a PLLC or LLC, you can just take the money out as distributions, however seem fit, whenever you feel like. If it's an S Corp, though, what you kind of have to do is play the game where you take enough as a reasonable salary, but then you also don't want to take all of it as salary because then you're paying Social Security and Medicare taxes on that entire amount. So you want to find like a good, fair wage to pay yourself, which is usually, it's honestly, it depends on how much the business is generating. There's some businesses where I would say like the most usually you would want to take is the full Social Security wage base, which is I want to say it's $150,000. I don't know the exact number right now, but say it was close. But sure. Depending on if you're making less money, you can take like less and less as an optometrist. It just depends on how much money is being generated. Usually, to stay on like the safe side, probably want to take maybe like 50% as wages, 50% as distributions, but it's just going to depend on the situation that you're in and how much you want to be taking as either and have like and just chat with somebody and kind of there's some different resources that you can kind of look up, and it's going to be dependent by like state too. Some
Right.
states cost of living's lower and you can get away, like you could get away with taking a lower wage in, I'm trying to think what the lowest cost of living. I think Mississippi is the lowest cost of living state in the US, where
Okay.
you could get a lower wage you could get away with taking a lower wage in Mississippi than you could if you were an optometrist and you were based in New York City. You
Sure.
would be able to get away with a lower wage, like taking a lower wage there. But you have to take the rule from the IRS is like a reasonable wage for that profession.
Gee.
Mhm.
So much for nice defined parameters, IRS. Thank
Yeah.
you. Hearts.
There really isn't a good parameter. You just want to be evaluating what is good for the area, which can be, it's going to vary by the area, vary how many days a week that you're working. There's a lot of factors in that.
Absolutely, absolutely. So really good stuff here, and I think also on in the context of that, Joe, pointing back to I'm really getting back to the whole tax planning thing, right? And knowing where you are, what you got going on, connect with professionals that understand what you've got going on and what is applicable also to you in your area, because again, it's going to vary by state. I mean, what we're talking about, I know for optometrists incorporating in different states, be sure you know the state guidelines. Yeah, same thing here as it pertains to from a tax standpoint and how much you should be paying yourself, how to go about paying yourself. Definitely explore that, get with a professional. So moving along here, the world of deductions and credits, and that has been a topic that has been brought to the forefront in these last few years, right? In the context of COVID, you had all these payroll tax credits, all these employee retention credits, and et cetera, et cetera. So why don't you share a little bit about the world of deductions and credits?
Yeah, so I think a lot of times what happens too is people confuse what deductions and credits are, because they're definitely two very different things in how they are treated. So I guess like the best way to describe it are deductions are something that lower your taxable income. So let's say, for example, like in a good example of this is say you run a business and you generate $10,000 of revenue, and then you have $1,000 rent expense for your business, and that's your only expense for the year. The rent expense would be a deduction. So you have the $10,000 of income, and then the rent expense is a deduction, which lowers your taxable income from $10,000 to $9,000. So at that point, you're paying, instead of paying taxes on the $10,000, you're paying taxes on the $9,000. So deductions lower your taxable income. Credits are direct things that you can do, which are, they give you basically either lower your tax liability or give you money to offset any or on top of what it. So like an example of like a credit would be the child tax credit, which was very common the past couple of years, where it was you get for each child under 17 years old, you get a certain amount of money from the government. And that's a direct credit where they give you a credit for exactly for this exact amount, which either lowers your tax liability or generates you an additional refund if you have more credits and tax liabilities. And then there's like other things too that are similar to like the child tax credit. One that's very common among optometrists is if you have your entire practice ADA friendly. For some of the equipment, you can qualify for disability access credit every year for $5,000. Which is exactly, it would lower your tax liability by $5,000. And so credits are items that directly lower your tax liability, while deductions are items that lower the base that your amount of money that you're taxed on, if that makes sense.
Sure. Yes. Yes. Fascinating. Well, man, I tell you, it's this has been really insightful conversation. We've touched on a few different things, and I know, look, this is only the tip of the iceberg. Hence us calling the episode "Accounting Basics." But on that note, Joe, I mean, what other things are? Why don't you share with us some of the most some of your most common pointers. I mean, what would you say your best tips are for optometrists? Again, you work with a lot of optometrists, a lot of dentists. What are some other need to knows that that you like to share with folks?
So I always say that when you are first starting a practice, make sure that you are on top of everything right away from like an accounting, bookkeeping, tracking your finance perspective, because it's something that oftentimes when people start, they are thinking, okay, I want to do this and do everything on their own. And then what happens, and they start doing it on their own for a couple months. And then what happens is then business starts to get really busy, and it gets to the point
Which
where
is what we want, which is what everyone
what you
wants.
want,
It's the
which is what you
goal.
want. And then you're spending more hours in the chair with patients, which is great because every hour that you're spending with patients in front of your chair, you're making money, which is great. But then other items that you used to be doing, you don't have time for them anymore, and they start to really get neglected. And then what happens then is then you get to a point where you're like, oh, I really got to catch up on this. And then at that point, you're trying to hire somebody to do it for you, but then they have to clean up 8-9 months worth of stuff before they can even start with the new stuff now.
Right.
And then it ends up kind of costing you more in the long run. And so it's okay to like, I know a lot of times, especially with cold starts, you want to control costs at the beginning. So you want to do this while you're not having other issues. But as soon as you start to run out of time where you feel like you're really starting to neglect it because you're spending too much time in front of patients, which is, again, good thing. You want to be spending all your time in front of patients making money. But then you want to make sure you're not neglecting anything and making sure that you have good accounting processes to the start so that it's easy to continue those as you grow.
Absolutely. Absolutely.
Mhm.
And I will say this, you mentioned the cost. As you know, Joe, we work with a ton of cold starts and we help a ton of doctors purchase practices. Banks in financing, they are willing to include professional services of CPAs right there along with any other line item in the startup. And that's something that in the startup investment that's going, as far as what's going to be in financing, that's something I suppose at times maybe some doctors, some entrepreneurs don't realize. Like, the resources are there for you to be able to have a professional team supporting you and your vision. So, well, Joe, so look, to kind of wrap things up, if folks would like to connect with you with any questions to continue the conversation or learn more about your services, how can they go about connecting with you?
So you can email me at joe@ericksontaxes.com. Or you can just visit ericksontaxes.com, and then there's a Calendly link there where you can go and schedule a time for a consultation to chat with me, and I'd be happy to answer more questions about your specific situation and get those answered for you, because I'm sure a lot of people have questions that just apply to their very specific situation where I need to get more details on before I answer those for them.
Yeah, absolutely, man. Well, again, Joe, thank you for all that you're doing. Again, I know we've got some clients that we work with together that, again, incredible things you're doing to help us help them bring their cold start vision to reality. It's really exciting. Thank you so much for joining us here, talking about accounting basics. On behalf of all of us here at Akrinos, check out Akrinos.com. Follow us on the socials. Subscribe to our YouTube channel for more great content like this. Joe Erickson, again, thank you so much for joining us on Access. Have a great week.
Yeah, thanks for having me.